Welcome to Advisor Confidential, the podcast series that dives deep into the evolving world of registered investment advisors. Whether you're an established RIA, exploring the independent advisory space, or just curious about the future of fiduciary finance, this is your go-to source. We'll bring you expert insights, candid conversations, and real-world stories from the front lines of wealth management.
What is actual investing? We believe that it's our real-world task to deliver thoughtful capital deployment. It's not about speculating over the short term, it's about understanding the long-term opportunities for companies through technological progress or new business models. So we seek out those exploring big, new ideas that will change the world. Then we back them to give those ideas time to flourish. Baillie Gifford, Actual Investors. Find out more at baileygifford.com.
Good day and welcome to Advisor Confidential, the podcast series. I'm Evan Simonoff, Editor-in-Chief at Financial Advisor Magazine. Today's episode, Asset Allocation Challenges Facing CEOs at Big RIAs, is brought to you by Baillie Gifford. I want to welcome our guest, Jasmine Yu, who is a PhD, CFA, and Chief Investment Officer at Bryn Mawr Trust and WSFS Bank. Today we are tackling something that sounds deceptively simple, but it drives everything that we do as advisors: asset allocation. Jasmine, how do you view it?
All right. Thanks, Evan. Thanks for having me on. Yes, the fine art of predicting the future with yesterday's data, that's asset allocation, and somehow keeping your sanity while everyone around you changes their minds every other day.
Yeah, you make it sound glamorous, but seriously, this is one of the most foundational yet endlessly frustrating parts of investing. Let's start at the very top. How do you do asset allocation?
Great question. I like to think about asset allocation in three layers, kind of like the foundation, the structure, and the finishing touches. So first, we've got the strategic layer. That's the long-term core. It's the 60-40 or the 70-30 mix, the big picture that aligns with goals, risk tolerance, and time horizon. We're not trying to time markets here. It's the set it and don't totally forget it approach.
Okay, so the idea is to stick with your long-term plan, but make sure it doesn't drift too far off course when markets move. Is that right?
Exactly. Markets shift. A 60-40 portfolio can quietly become 70-30 before you realize it. So you rebalance, trim what's grown, add to what's lacked, and bring it back in line. It's a simple theory, but emotionally hard because you're selling what's working and buying that's not working, which always feels wrong in the moment.
Okay, so that's the long-term foundation, but I've heard you mention capital market assumptions before. Exactly what role do they play? After long-term trends take place, you sometimes change your assumptions, or markets do.
Yep. CMAs, right? Capital markets assumptions are the math behind the long-term strategy. Typically, the 10-year outlook on returns, risk correlations. It's the long-term strategic layer, typically anchors, right, on CMAs as input. And the long-term layer anchors about half of our total risk budget. And this layer is totally unemotional, systematic, and keep us grounded when the news cycle feels like a tornado.
Okay, so then there's the tactical layer?
Right. Tactical allocation is where we tilt, not jump. based on valuations, rates, central banks, geopolitical shifts, for example. It's subtle, not dramatic.
And is this where a lot of client conversations happen, especially when there are major movements or serious volatility?
Yes, institutions rarely care about technical views, but in private wealth in particular, these short-term tilts create context. They make portfolios more connected to the world. And we typically allocate 25% of our risk budget to technical moves.
Okay. And what's the last layer?
Execution, manager and security selection. Even the best top-down view fails if you pick the wrong bottom-up implementation. So another 25% of our risk budget goes there.
Okay, so your three layers are structure, flexibility, and execution?
Exactly. The long-term map, the tactical compass, and the day-to-day craftsmanship that makes the journey actually work.
Okay, that's the framework. Let's talk about what really happens in the wild world. Because, clean as that sounds, markets are never very often that clean in reality.
Not even close. Asset allocation sounds elegant, mix some asset classes, optimize, compound. In reality, it's like baking a cake during an earthquake, while the price of flour changes mid-recipe.
Well, okay, that's a great analogy. What exactly makes it so tricky?
Every allocator wants a crystal ball. Instead, we get economic forecasts, Fed speeches, and models, none of which agree. By the time we have updated our assumptions, the next market regime has already shown up.
So it's like playing chess on a board that constantly is changing shape?
Right. Asset allocation is basically a game of incomplete information that's constantly shifting.
All right. What about diversification? Isn't that supposed to be the magical shield to protect investors, clients?
Bonds used to be the perfect counterweight to stocks. Then 2022, remember 2022 came along and said, actually, we're all going down together. Correlations, rise, right? When you wish they wouldn't.
Yeah. So what you're saying is diversification isn't dead, but it's definitely been humbled in the last 5 years.
Exactly. Correlation, diversification still matters, but you can't assume the same patterns will always hold.
Okay, let's talk about the behavioral side because that's where I've seen a lot of investment plans go sideways, and I know a lot of advisors say that behavioral finance is a very big part of their job.
Totally. The market isn't always the biggest source of volatility. We are. Clients panic, advisors freeze. Everyone wants to wait until things feel more certain during down markets. And of course, that's usually the exact moment when opportunity knocks quietly and no one answers.
So when the times when things feel the safest, it's usually right about when the rally is on its last legs.
Right. As CIOs, half the job is managing risk, the other half managing emotion.
Yeah. Isn't there also, a lot of advisors, big asset managers have pretty robust models, but haven't you experienced or others experienced quite a bit of overconfidence in models? The spreadsheet says so problem.
Yeah, we build these beautiful, gorgeous spreadsheets that are perfect until they're not. A tiny tweak in assumptions leads to widely different allocations. As the saying goes, all models are wrong, but some are useful. So the trick is knowing when the models stop being useful. And most of the time, we are 70% qualitative and 25% quantitative using models.
Okay, then I guess kind of the fun part comes when you actually have to put everything into action.
Right. This is all about execution. Execution matters, inclusive of liquidity, taxes, costs, and importantly, rebalancing, as I mentioned before, means selling winners and buying losers, which always feels like the opposite of our instincts.
Okay, and every few years it would seem there a new shiny object comes along, whether it's crypto or lately private credit and AI funds, where clients tend to see those, tends to catch their eyes, doesn't it?
Each one promises diversification, uncorrelated returns, and each of these new shiny objects comes with its own unknowns. So the challenge for us is separating what's durable from what's just hype and figuring out how to add the new without breaking the discipline of the core portfolio.
Okay, well, we're about to head into E26, a new year. What are the biggest questions on your mind when it comes to asset allocation going in 2026?
The biggest one, and probably the one keeping most of us up at night, is where the S&P 500 lands next year. US equities make up the majority of the risk in most of the portfolios. So the direction of US equity really drives everything else. And right now, it's a tricky setup, right? US equities have had an incredible run after 3 years of strong double-digit returns. It's fair to wonder how long the music can keep playing.
Yeah. What kind of questions are you hearing most often from clients right now?
Well, that's an easy question. It's all about gold and AI. Those are the two trades everyone wants to talk about. One is about classic safe haven. The others is the new shiny thing we talked about.
Yeah. Well, speaking of AI, do you think we're in a bubble? This seems to be the conversation of November.
Well, we think it has the features of a bubble. Massive capital inflows, stretch valuations, excitement unconnected to near-term earnings. But we're also cognizant bubbles can last. So we like profitable AI companies, not just AI theme stickers.
The S&P is up about 16% this year, though the last 2 days swings have been pretty wild. But international markets have surged even more. Some are saying that domestic stocks could underperform for a sustained period because they've outperformed for so long, as you alluded to. How are you thinking about the US versus foreign equities?
We are modestly overweight equities overall, funded by trimming fixed income right now. We favor high quality US large cap growth stocks, underweight US small caps, neutral on international developed equities, and a touch underweight EM. Yes, we run a very small sleeve, about 50 basis points in Bitcoin and Ethereum.
Okay, let's talk a little more about emerging markets. They have all the right traits you would look for. They've got good growth. They've got good demographics. Most emerging markets have better fiscal positions than the US and Europe or Japan. And yet performance keeps lagging, or occasionally they'll keep up, but they really haven't delivered what some people have expected. What's your read?
In general, EMs shine when global growth is strong, commodity prices rise, and the dollar weakens. But if you look closer at the company level, returns on equity and returns on assets tend to lag developed markets. I think governance and efficiency matter. Additionally, EM isn't one thing, right? It's comprised of many different countries and regions. So ideally, we could use a barbell approach. A global emerging markets manager for top-down calls, plus local asset managers to pick winners on the ground.
All right. Before we jump into fixed income, let's touch for a second on inflation. And specifically, is 3% the new normal?
I sure hope not. Inflation looks to be easing in the next few quarters, but could have the potential of coming back later. The reason is because of tariffs, trade frictions, rate cuts. These could further weaken the dollar and push import prices higher. That's why we have been leaning into real assets and staying away from the long end of the treasury curve.
So how are you exactly positioning your bond portfolios?
We're underweight high yield credit today. Spreads are too tight. We like international exposure with currency upside. We're also avoiding the long end.
And last question, private equity and private credit are getting so much attention. What's your take about them? They're two different spaces, really, but curious as to what you think.
Sure, both are great spaces, but liquidity matters. We always know best private equity vintages tend to come after downturns. We're not there yet. Private credit has opportunity, but the flood of capital means you must be selective.
Okay, that's what you just said is a great reminder, because it's not just about being right. It's about how long you can afford to be wrong.
Exactly. Asset allocation is part science, part storytelling, and part emotional resilience. Our job is to build portfolios that can handle what we cannot predict, and then let compounding do its quiet, boring, magical work.
Okay, so stay curious, stay alert, stay disciplined, and keep a healthy dose of skepticism. Is that sort of your approach?
Right. That's how we get better at this craft. This endlessly fascinating, occasionally maddening craft we call investing.
Okay, well, thanks for joining us, everyone. Thank you all for listening to Advisor Confidential. And this is where we explore the rapidly evolving world of financial advisors. 2025 Advisor Confidential podcast series and today's episode are brought to you by Bailey Gifford. Get in touch with us at Financial Advisor Magazine to learn more about expert wealth management, growth advice by visiting fa-mag.com. Don't forget to subscribe and click the follow button and never miss an episode. We look forward to welcoming you back for the next episode of Advisor Confidential, the podcast series. Thank you very much, Jasmine.
Thank you, Evan.
What is actual investing? We believe that it's a real-world task to deliver thoughtful capital deployment. It's not about speculating over the short term. It's about understanding the long-term opportunities for companies through technological progress or new business models. So we seek out those exploring big, new ideas that will change the world. Then we back them to give those ideas time to flourish. Bailey Gifford, Actual Investors. Find out more at baileygifford.com.
Thank you for listening to Advisor Confidential, the podcast series, where we dive deep into the evolving world of registered investment advisors. From compliance to client experience, digital tools to succession planning. We cover what matters most to RIAs today. Learn more by subscribing to this podcast or visiting fa-mag.com.